Hey there, Jordan Schwartz with Strategic Wealth Designers, and today we're talking about asset allocation models. So we're talking about asset allocation models. Tell me if you have heard this 5,756 times. What you want to do is take your portfolio, put it in a well-diversified portfolio of stock funds and bond funds, preferably split it based on your age. Never look at it, leave alone, and pay a lot of fees. Does that sound familiar? The vast majority of people's portfolios have a diversification model, but not an asset allocation model. To keep it really simple, diversification doesn't do what it needs to do. Diversification means your money is spread out. What the vast majority of people who are probably watching this are doing is they only have stock funds, bond funds, and maybe a little bit of money market or cash inside their 401ks. That is not enough to cut the mustard. That is not going to get you through retirement. You need a whole lot more than that. Asset allocation means where's your money at? Stocks and bonds are in that equation, but there's precious metals, real estate, commodities, master limited partnerships, floating rate securities, gold, all these different investment classes that are all moving in different directions. The hinge that swings the door open is a simple concept for you. I'd love you to write this down: non-correlated assets. It means investments that are doing different things. So if we think about asset allocation models, there's a couple I want to share with you guys. First and foremost, and if you've watched any of our videos before, I know you've seen these. First and foremost is the rule of 100. It's very simple. Basically what you do is you take your age. That's the part of the portfolio that needs to be safe. So if you're 60, it needs to be safe. The remaining part of your portfolio, number 100 minus your age, that's 40%, and that's the part where you can take some risk. Now, what most people and where they get this wrong is they use the wrong investment tools for 60-40. See, they put stocks here and they put bonds here. Bonds are safer than stocks, but safe is a relative term. Bonds have inflation risk, default risk, and if you're in bond funds, you've got stock market volatility risk because it's traded on supply and demand economics. So we've got to figure out what goes in these two investment portfolios. When this means safe, it means it can't lose. If you think about the investment world for a second, we're looking at things like cash, some treasury bills, bonds, notes, not normal bills, bonds, and notes, treasury bonds, bills, and notes. Also, you could look at different types of annuities. You could look at any investment, especially to non-correlated assets, right? If you look at gold, it's incredibly volatile. But if you have gold in a portfolio constructed properly, it creates safety because of the non-correlated asset nature of the portfolio. The easiest part right here, risk, is the part where we are trying to do what the stock market does. And you can use stock ETFs or stocks. I would not use mutual funds typically because a lot of times the fees are higher. But the big variable with the rule of 100, it's not enough to do 60-40. You got to get the right 60 and the right 40. What are some other asset allocation models? Risk parity. This one's a big one. This is a large fundamental of how we manage our portfolios. I'll get into the simple of it. It would take me about 4-hour long video, which of course I'm sure all of you would love to listen to me talk for 4 hours. Risk parity. If you think about the economy as a whole, there are 4 different economic seasons. There are high growth periods. A lot of that happened in 2019 and very early 2020. We have low growth period. Think of COVID, think of 2008, think of the dot-com bubble. We have high inflation and low inflation. Those are the only 4 different economic seasons that dictate whether or not your retirement is successful or it fails. So we've got 4 different economic seasons. If you had to guess which of these 4 seasons right here are the vast majority of people's money then? You guessed it, high growth. If we think about these 4 different economic seasons, and you think about this for a second, there are 4 different economic seasons. Probably 80 to 90% of your money right now is only poised to do well during high growth, maybe a little bit of high inflation. What we want to create is an environment where we have equal risk distribution among these 4 different economic seasons. See, high growth, stocks do great there. What happens when the market's falling? Treasuries, oftentimes precious metals. What about high inflation? Tangible assets, real estate, Floating rate securities, which are basically bonds that have inflation protection built into them. Real estate, as I said, commodities. What about low inflation? What about when nothing's doing well or things aren't in a good environment? We have, again, non-correlated assets in all 4 of these different economic seasons to make sure our portfolio works well. Now, what we can oftentimes do too is blend these portfolios together. See, if you're a very conservative investor and you want your money to be secure, obviously safe money can't lose. Because with a strategy like this, you could contain your risk in a 2008 event to about minus 10%, when that actually 08 did about a 50% drop, meaning you have 1/5 of the risk. What you can do though, if you're super conservative, maybe you don't want the entirety of this part of the portfolio in the market, because you don't want to gamble with that. Maybe you've had bad experiences in the past, or you think you have enough money, and maybe you've talked with your advisor and you got enough money. You just don't want to lose any of it. What we do a lot of times, you can blend the rule of 100, the safe money right here, and then you put this risk parity strategy in the remaining part where we can take some risk with it. What you do and what you're creating is an environment where you have the best of all the worlds. Those are 2 great asset allocation models you can use. You can use the rule of 100 with the right investments, or you can use risk parity, and you can even blend them together. If you'd like more awesome videos like this, give us a like below, subscribe, and see us for our next video soon.